It's a troubling time when you look at the property market broadly, maybe specifically in commercial, but it sounds like, Michael, residential, there's some things to like.
Yeah, I think it's instructive to think a little bit about where we've been in the recent past and kind of frame where the stocks are going. The last 3 years have been tremendous for apartment landlords. They've been able to push rents during the pandemic. That's especially true in the Sun Belt, where we already had a secular migration of population and jobs into that region. That was accelerated during the pandemic. And so that was especially strong, and it was reflected in the stock prices. The Sun Belt REITs outperformed. When we got to the beginning of this year, as is prone in the Sun Belt, it's easy to build there. And we're starting to see the leading edge of a supply wave. As we look out over the next 12 months, we think deliveries peak sometime in the first half of next year. And so the stock market forward looking, again, has now kind of reversed itself. The Sun Belt names have underperformed year to date. The coastal names have outperformed. Those stocks, because they've outperformed, we think they're a little bit less attractive. The upgrade of UDR and apartment income REIT, we think are kind of tweeners, right? So we screen all the markets by job growth and by supply growth. We think both of these screen as above average on both. And we think with their strong NOI margins, they're poised to post better growth over the next 12 months.
How do rising interest rates factor into your call?
Yeah, so that's more of a broad REIT question, right? So interest rates have been a huge drag on commercial real estate. They're levered investments. They're often viewed as income vehicles. So you have other high yield vehicles that are now competing for the same dollars. And we've seen multiple contraction. In apartment REITs, financing is a little bit more readily available. You have some agency debt and other things. The REITs don't use it a lot, but it's there. The REITs are also much less levered than the typical private investor. So you'll see 30% loan to value, where you might see double that in the private markets. And so the balance sheets are in good shape. I think overall, though, we're looking forward to a time when interest rates ease a little bit. Maybe there'll be some more flows into real estate. And I think when those flows do come to real estate, I think they'll come to the listed space, because we do think private market values are expensive relative to what you could get in the listed market with the REITs.
What are the movements out there? Are we seeing a lot of consolidation? Are we seeing, more players pop up? What does the landscape look like?
Yeah, the apartment REIT space has been one that's been ripe for consolidation. There's been a lot of consolidation over the years. We've really ended up with a core group of REITs in the sector now that are very high quality, very competitive. There could be some opportunities to pick up some smaller ones, but the cost of equity isn't really there, and the cost of financing is expensive. I think it's harder to make M&A work in this environment. You also, employment is the primary driver of demand. That's obviously easing. It's not uniform, so California is slow, but Tampa and Dallas are stronger. But that also kind of casts a pale, I guess, over the forward outlook when you're dealing with high rates and you're dealing with easing employment.
And Michael, looking through your call, it's interesting. Of course, as we mentioned, you upgraded UDR and apartment income REIT, but then you look at peer Essex Property Trust. You actually downgraded that name. What's the difference there? Yeah,
so we made a swap here, right? So Essex has been an outperformer on that coastal theme. They're focused on the West Coast specifically. And when you look at those West Coast markets, the labor market growth has been lagging. The employment growth has been lagging, and the stock has outperformed a little bit. They do have low new supply, and I think that's been the focus for investors. But we saw a relative value opportunity there. The coastal name, again, has outperformed, and it's got lower growth. We see better growth at UDR and AIRC and at better stock valuation. So we thought that was a good tactical trade. In the long run, Essex will still benefit from low supply in its markets. It also, Northern California especially is a boom-bust market. When it busts, it really busts, and when it booms, it really booms. Over the long run, that's been good for them. We'd like it as a long-term performer, but we think this is a good tactical call while that market is kind of, lagging in the near term.
Talk to us a little bit more about supply, because we talk about supply in the housing market all the time. The fact that there really doesn't seem to be any. When it comes to the rental market, when it comes to some of the apartments and the apartment REITs that you cover, what's the supply picture there? Yeah,
I'll tell you what the bifurcation really looks like. So a pure Sunbelt name like an MAA, we think over the next 12 months, supply is going to be up about 4.5%. You compare that to a bi-coastal name like an Equity Residential, we think it's going to be more like 1.5%. So it's a real dichotomy of what's happening. And again, it speaks to how much easier it is to build and add new product in the Sun Belt. the phenomenon you're talking about in the existing home market, that's a positive for apartments, right? So not a lot of existing home inventory to move into. Now, the REITs don't have a lot of move-outs to home ownership. It's a little bit older, more affluent renter in the institutional quality product. But that certainly is helpful that there's not a lot of options to move into a single-family home.